on some optimism in that space that there'd be some M&A activity, up by $1.90 to 102.56. But Apple, number one with a 103.74 handle, gained 62 cents today. That contributed to the NASDAQ Composite Index and the Dow Jones Industrial Average, quite frankly, but both of them slipped negative. Down 19 points, 205-point discount to 15,665. You know who I'm going to blame for this? Guy in Chicago, chief strategist at BubbaTrading.com, Todd Horwitz. What are you doing to me here?
That's because I'm a seller. I told you, sell, sell, sell. Sell, Wilson, sell. I'm Michael. You know, it's funny because, you know, Apple was at 111. It opened at 111.11 this morning, and Gilead was trading about 108 before they broke out. But, you know, again, it really looked more like a dead cat bounce. When you look at the overall picture, we've been down 6 out of the last 7 days, or 5 out of 6 coming in. You get a dead cat bounce after a great day yesterday. Typically, those are meant to be sold into. I think the fire got fueled a little bit later. I think there were some rumors out of China. I'm not really sure. I haven't heard them yet, but I think there were some rumors about something going on with their government. Who knows? But at the bottom line, that helped accelerate the selling. But the markets basically opened up almost on their top tick, and all day long, they just kind of worked their way lower. And really what happens at the end of the day is people go, we're not going up. I'm getting out, and the sellers come in and sell. And I think that's what you can look forward to see here is more selling pressure. I think the markets are really on the ropes now. I think there's a lot of trouble, and I think not only are we in correction territory now, but I don't think it'll be long before we'll be in bear market territory.
Well, where's the bottom, and what's the point at which we decide that we've gone as far as we need to fall?
Well, I think the bottom is significantly away from here. I actually think I'm looking at it one level at a time, but my big level that I'm waiting for would be about 1586, which is about another 18% from here. What? Before I would even think about buying. Let me what?
18% from here? I mean, 18% from here?
When you borrow, when you have an artificial economy, when you have a Fed that tries to study theory and doesn't want to act really to what the markets really need, when you have a Fed that day trades the market, you end up in a mess. And these are the unintended consequences of what the Fed action and the central banks around the world. Everybody's worried now about the currency wars, but nobody talks about the person who started the currency wars, which was Ben Bernanke. So when we look at the overall picture, we're seeing exactly what we deserve. You built an economy on a house of cards that had no real growth. Are we going to really talk and cheer about 200,000 jobs a month when they're 90% are minimum wage or service jobs? Of course, when you lost 50,000 jobs from Schlumberger, which was more than the 200 that you gained, that's a problem. The economy is not being stimulated. The middle class aren't spending. So without the middle class, you're going to see a continued drop in this market, and that's really the overall problem. We're not growing. We're not getting what we really need to do. And all that really is benefiting here is the banks and the Federal Reserve feeding the banks.
Now, you said that you're selling into this market, but I follow you on Twitter. I know you were buying in the energy patch today. What were you buying?
I like buying the energy patch. I think the energy patch has made, it could go lower. Again, look, we all know that commodities have a tendency to go farther, but I do like energy. I like oil here. I think that oil, could go to 35. Look, it might go to 32. But when I look at the model, and I look at the risk reward, and if I'm going to truly believe that eventually this economy is going to turn around, then oil should be a fairly good play here. And I think it's a safer play. I think if you look at some of the beaten down names, take a look at Chesapeake as a natural gas play. Stock's down to 650. Now, again, it might go to zero, but it's a stock that's been traded up in the 20s, and now it's a 6. And again, I'm not looking for it to go back to 20, but I think it's a great play. I think Halliburton has been just unmercifully beaten down to the ground. I think gold and the gold miners look very good here. I think, again, these are unloved things that you would think with all the trouble in the world that gold would have rallied, because many people consider gold a currency, which I don't. I consider it a commodity, but it is a good hard asset that I think everybody should own a small portion of. And I think we've seen evidence that now gold held that 1080 level, held 1100, and looks like it's going to hold this 1140 right in this area. And I think somewhere near it you want to start to buy. I don't think you want to load up, but I think you want to start to accumulate some of these beaten down commodities, because commodities are on 17-year lows right now.
Do you want to own the underlying commodity, or do you want to own the equities? I can imagine there's a greater risk with the stocks versus the actual commodity of gold itself.
I think that, certain things you want to own the physical, and gold I like owning both. When I buy gold and I put it in my vault, I put that away, I forget about it, and I do trade the paper gold. So I think both are good. I think if you're gonna say to yourself, hey, I want to own gold and I'm gonna put it away, then you buy the physical and you just put it away and forget about it. If you want to trade gold, because there's two types of players, an investor and a trader, and I do both. So when I'm trading it, I'll trade the paper gold either through GDX, some of the gold miners, or GLD, or some of the other ones where I like to trade a lot of silver. I'm a big fan of silver. I think that's a big play here as well. I think you have to look at it, and depending on what you're looking to do with it longer term, that's how you trade it. But I'm not afraid of some of the paper ones. If they're good, solid companies, I'm more than happy to get back involved, because I believe that history will show that a good, solid company that's taken under some hard times will be able to overcome when the markets turn, and they will be able to benefit.
All right, back to the markets. Before we let you go there, Bubba, let's talk about the sell-off that we saw towards the end of the day. Some say that this was short selling and that there was really no conviction behind the buying. Is that your argument too?
I believe so. I believe it was a short covering rally, and I think that the sellers are definitely in control right now. The biggest thing we have to look at, Michael, two things, and then I know you got to go, but you have the death cross of the Dow, which is, by itself is no big deal, but that's when the 50-day cross is below 200, about 10 days ago. But the bigger thing is we were in the tightest consolidation range in 115 years percentage-wise. We broke to the bottom side of that. Anytime that happens, the longer you're in consolidation, the bigger the break's going to be. And that's what really, technically from a charter standpoint, we broke to the bottom side of all the major indexes, which looks to mean that they're going to sell off quite a bit from here.
All right, Bub, good to have you with us. Thank you.
Thank you, Michael. I appreciate it.
Todd Horwitz, Chief Strategist at BubbaTrading.com in Chicago. Still